Welcome to ETF Battles. I'm Ron DeLegge, where 99% of all statistics only tell us 49% of the story 100% of the time. And that's one of the reasons this program exists, so that we can explain to you the 51% of the story not explained in the stats. By the way, the one statistic that's exempt from this cardinal rule is that 100% of profitable investing is 99% execution and 1% strategy. Okay, enough with the cute talk. Today's melee is between the Invesco Fundamental High Yield Corporate Bond ETF, that's ticker symbol PHB, versus the iShares iBoxx High Yield Corporate Bond ETF, that's ticker symbol HYG. Both of these ETFs are invested in the same exact area, bonds with a low credit rating, also known in hostile circles as junk bonds. By the way, somebody told me that Michael Milken hates being called the junk bond king. Is that true? Because if it is, it's that much more satisfying to publicly declare, Michael Robert Milken, you are the junk bond king of all time, and nobody even comes close, not even Argentina. Helping us to judge today's matchup is Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and John Davi, founder and CIO at Astoria Portfolio Advisors. Gentlemen, welcome to the program.
Great to be with you again, Ron.
Great to be on ETF Battles again, Ron.
So the four battle categories are cost, yield, performance, and then the mystery category where you as judges get to choose that one factor or several factors that you feel is crucial to support your analysis. I have no idea what the mystery category is. Our judges have that up their sleeves and they will reveal it to us later. My scorecard, as you can see, is ready. And we've even made space for Kenny Rogers, whose trading advice was to know when to hold them and know when to fold them. So kudos to Kenny on that. So we're going to get going with our four battle categories one at a time. Each of our judges is going to pick PHB or HYG as the winner in each respective category. They can also opt for a split decision. It's up to them. So let's begin with the first category, cost. John, we're going to begin with you. Who wins the battle when it comes to cost, PHB versus HYG?
So in this case, HYG is cheaper in terms of management fee, 1 bip cheaper, 49 bips versus 50 bips. It is also tremendously more liquid. It's really an institutional product. A lot of credit asset managers, hedge funds will go long or short in order to kind of express views. In the high yield credit space, there's also a pretty deep options market. So I give the edge to HYG in this case.
All right, that's a great start. Let's shift to you, Todd. Who wins the battle when it comes to cost?
Yeah, I don't think it is a difference. 1 basis point between them from an expense ratio is minimal at best. We certainly have seen, yes, there's more liquidity in HYG versus PHB, but for the clients that we're talking with at CFRA and wealth management space, there's sufficient liquidity in the case of PHB. And I would note that it tends to trade more in line with its net asset value. HYG tends to be more of a premium and more of a discount, so there's the opportunity there. So we would put this as a wash. I would put these as a split decision between the two on a cost perspective.
Thank you for that analysis. We need to move on to the next battle category, which is a big deal for income looking and searching bond investors. And the next battle category is yield. So we're going to stick with you, Todd. Who wins the battle in this category?
So from a high yield perspective, you certainly want the income, and HYG brings it. It has a higher yield, in part because it's taking on more credit risk versus the Invesco product. So if you're comfortable taking on that credit risk, that yield is going to be 70 basis points higher for HYG versus PHB as of the latest data that we at CFRA have. So again, HYG is the winner from a yield perspective.
All right. What about you, John? What do you have to say to that? Who wins the battle on yield?
I would let me just mention that at Astoria Advisors, we don't just buy because something is higher dividend yield or higher credit yield or has a lower management fee. I think you really have to do your analysis. What's going on in the market? Do you want something that's junkier credits? I personally think, you want to have a little bit of a higher quality tilt to your bond portfolio. Those tend to be a little bit more inversely correlated to stocks. I think HYG, lower quality credits, it'll act like equities during a big risk-off event like what happened in March. So for 100 bips difference in terms of yield, I don't think you necessarily would choose HYG. I'm a big believer in factor-based investing, and I like the quantitative overlay that Invesco provides on PHB. So I would give like the yield per unit of risk edge to PHB in this case.
All right, very good. So that's differing opinions in terms of yield for our judges. We need to move to the next battle category, which is performance. We're going to stick with you, John. Who wins the battle?
PHB this year, it's outperformed HYG by about 100 basis points. I think that's a lot due to the higher quality tilt that they have to picking their credits. HYG has, more in the lower quality space. Even on a 1-year basis, it's PHB is outperformed by about 50 basis points. On a 3, 5, 10-year basis, they're pretty much even. I give the edge to PHB just on an overall, Sharpe ratio basis.
Thank you for that analysis. How about you, Todd? How do you see it in terms of performance between PHB and HYG? Who has the edge?
I would agree. So they're in line with one another as you look on a longer term perspective. PHB has been better on the more recent period. We at CFRA think you shouldn't look too far in the rearview mirror when you're choosing based on an ETF. And so the shorter time period is more comfortable to us. And yes, from a risk adjusted standpoint, I'll agree with John. So I'd give the nod to the Invesco product, PHB.
Okay. And now we need to move to our mystery category, which is one of my favorites because it always keeps us on the edge of our seats. We never know what our judges have up their sleeve, but it's always something good. And it always helps us, too, to have a little bit more perspective on each of our ETF battles. So we're going to stick with you, Todd. What is your mystery battle category, and who is the winner between these two ETFs?
I'm using an in-house category. So we at CFRA have a holdings-based rating of fixed income ETFs, over 200 fixed income ETFs. That is a star rating. And both of these ETFs get a 5-star rating from CFRA during the month of August. We think from a risk and reward perspective, they're in line with one another from a performance and holdings basis. And we touched on costs earlier, that they're essentially in line with one another. So again, sorry to do another split decision. These are two high quality products within the high yield space, but PHB and HYG both get a 5-star rating from CFRA.
Okay, so that's going to be a split decision in terms of the mystery category. We got your category being holdings based. Thank you for that analysis. Let's shift to you, John. How do you see it? Tell us, what is your mystery battle category and who's the winner?
Sector weights, I think, is something that you want to look at. What I think people tend to do is just buy an ETF because they give you, a certain amount of yield and they don't necessarily look and see. PHB has 88% in the industrial credit space, whereas HYG has 88% between consumer and the communication sector. So consumer cyclical, consumer non-cyclical, and the communications. They're not overly diversified, so I think it's a wash. I think it's also a tie for this category, but just be really mindful of sector weights when you're picking ETFs.
So your mystery category winner is a split decision?
Tie, yeah, split decision.
Okay, split decision. Well, there you go. Fantastic analysis, judges. And according to my scorecard, we have got a split decision here between PHB and HYG. Can you believe it? Mm-hmm. You guys...
I think, Ron, if I may, I think that's impressive. That just shows you the quality of PHB because HYG is by far the larger of the products. It's the default product when people tend to think of the high yield space. It's what the Fed is buying, and yet it's what John at his firm and we at CFRA think is in line with PHB and HYG. So that just is a sign that investors need to go beyond the largest and the most liquid of the products around.
Yeah, that's a great point. John, do you want to mention anything and weigh in on that?
Yeah, no, I think Todd makes an excellent point. I mean, PHB, just having that fundamental quality filter, we're big proponents of factor investing. We like quality as a factor in equities and fixed income. So the fact that it goes, head to head with HYG, which is the behemoth in the space, I think you got to give credit to Invesco and what they've done and with their product. So.
Yep. Well, outstanding analysis again, judges, for helping us sort through this matchup. And a big thanks to both of you for helping us sort through, again, this melee. And a couple of key takeaways from today's show. First, Michael Milken is still the junk bond king of all time, and nobody even comes close, not even Argentina. Next, an easy way to reap more yield is simply to contain your investment costs. So just do it. And then thirdly, I think as our judges pointed out, look beyond the index, because the way that ETFs are structured, not all indexes are the same, and there's little details, as you just discovered, the way that these indexes select securities, there's important details that can easily be missed if you don't pay attention. So hopefully we've brought that to light in today's episode. And again, thanks to our judges, Todd and John, for excellent work. Before signing off, which ETF battles would you like to see in our next episode? Be sure to post your thoughts on our YouTube comment section. You can also hit us up on Twitter. @ETFguide is where you find us. Thanks for watching. I'm Ron DeLegge, and until next time, watch the battle before you invest, right here on ETF Guide TV.